Welcome to Blaxe Academy Technical Analysis. In this video, we will discuss a practical way to use a very important concept from classical technical analysis: support and resistance. Just as a background, support and resistance are price levels at which the markets will tend to stop and reverse in the opposite direction. For support, the name implies it. It's a spot where the market has difficulty going below. Look at the green supports in the picture to the right. Resistance is the opposite. It's this analog. It's the spots in the market where the market has difficulty moving above. For support and resistance, they tend to be dynamic concepts. It tends to be more art than science. And more importantly, it's up to the trader to make the observations about where support and resistance levels are and how to use them. One of the endearing characteristics of both support and resistance is that as the markets change, the levels that were once support can be broken and then provide spots to resist the market later on. The same thing happens for resistance in the market. What was once resistance can be broken through to the top side, and as the market starts to regress or retrace, this same area that you've already seen resist the market can provide support. This dualistic concept, this dualistic characteristic of support levels and resistance can be used by traders to find good trade setups. We'll explain. As stated, areas of support under certain conditions, the conditions namely being when they're broken, can turn into resistance points. And we have what's called an STR for short, or support turn resistance. This is the concept. You can see in the picture here that we have a support that is validated by the second touch of the horizontal dotted line. You can notice in both times, and for some of you may know this is called a double bottom here, where the price bounces higher and then returns to the support. That sort of just validates that level. However, on the third attempt to that price level, this hypothetical price breaks lower, and upon returning higher, as prices start to turn higher in the market, as things happen in the future, that same point, and sometimes honestly it's a range, can provide resistance to the market. If you can observe it being support at one point, you can keep that same spot in mind and wait for it to actually become resistance. Once you make the observation of support and then look at it as returning to resistance, this becomes a place in the market that has a higher than average chance of setting up a winning trade. Conversely, resistance turn supports, or RTSs, it's the same thing in reverse. You have a point to where the market can't seem to get higher, kind of bounces around in a range, and then once it breaks through, oftentimes you just simply need to mark this level in the market and wait. One of the key things that I say to traders looking to use STRs and RTSs is that in many trading platforms, you can use alerts. And what does an alert do? You can set an alert with some conditions, whether the price going above it, price going below it. You can actually, in some platforms, set how many times it has to occur to give you a notification. But once you get your notification that a certain price level has been breached to the top side or the bottom side, you can go look for other keys, other clues, other chart-based either patterns or conditions to let you know that, hey, this may be a good setup. And the best part about this is, depending on your time frame of trading, depending on your market, it could be hours later, it could be weeks later, days later, even months later. One of the best things for me, being a busy fund manager, a trader, and also educator now, is that I often get alerts that happened that I placed months ago. But because I keep good trading records, I review my trades, I review my analysis, it just jogs my memory and I know what to do. And it, to me, seems like a gift sometimes, because often it would be trades that I'm not even looking at, markets I'm not even looking at, and I'm handed an opportunity to try to take advantage of. It seems like you're doing the work in advance, and it's a return on an investment in your time and analysis. We're going to look at a few markets and find some examples of both the supports turn resistance and the resistance turn support, to give you an idea of what you should be looking for and how you should play these to make these useful tools and useful setups, hopefully to augment your trading strategy. Our first market guest is Nike. It's a stock that many of us know, or at least should know, one of the most popular brands in the world. Don't pay too much attention to the chart labeling here. This is just some work I did in Nike before this video, showing another tool that we at Blaxe Academy admire and use a lot, which is the measured move. This is an augmented variant of it. But right off the bat, I'm just going to show a pretty ideal version of, or I guess I should say maybe not ideal, it's a simple version of a resistance point that turns into support. The labeling here sort of gives it away, because if you look from this low, from the 2020 March lows up to this high around the end of the year 2020, this is a resistance point. You say, well, how do I know it's a resistance? Well, it's simple. As you look forward in time, it takes a considerable amount of time, takes months, for the price to actually go above it. In fact, it must have been a blowout earnings report, for the period ending May 2021, in which Nike prices gapped higher, another important technical analysis function, to actually break through that resistance that had lasted for, looks like, the better part of a year, almost a half year. So one of the things to note, and this is whether you know for sure or you feel confident about it, but once you find a significant high in a market, one of the easiest ways to mark a potential resistance that may turn into support later is to simply put a horizontal line at the peak. And you can see in our chart, as I get a little closer, I'm going to make maybe a slight adjustment here, not too much, it doesn't really matter much, that for the most part, if you look at the dotted line straight across, this resistance lasted until it was broken, and it was clearly and decisively broken. Nike shares raced much higher, but just like in the observations of technical analysis, the price retraced. You can call it a correction, retracement, whatever. But lo and behold, it wasn't exact here, but it was pretty close. Within a few percentage points, the price bounced and moved higher. This is exactly what we would call resistance turned support, or RTS for short. Now, if you know some of the other tools we use, namely Fibonacci Retracements, you can see that if I were to look at the move here from B, the low here at B, to the next high, as the price broke through that resistance point at the end of December of 2020, I can do a Fibonacci retracement. Now, you may be asking yourself, why would you want to do a Fibonacci retracement if you've already identified a level that is an RTS? Well, you don't necessarily have to, but confluence of different types of tools, different ways of analyzing the market that say the same thing, that are confluent, that say, hey, we see the same thing, tends to strengthen your argument. Because remember, as we're seeing the chart now, even though the markets are open, we're looking at a spot that happened in the past. We're looking with the benefit of hindsight. When you're trading, when you're analyzing, you're going to be walking forward in time. So you won't have the benefit of knowing that there actually was a bounce in price and that this was a successful thing. Remember, markets are a lot of things, but they're not certain. So you want as many of your technical tools. You don't have to overcrowd your tools. You don't have to use an excessive amount, but the more the merrier up to a certain point. So if the RTS level shows you a possible place where resistance could turn support, or in the case that we'll show later, support turns resistance, oftentimes it's a really good idea to show those levels with another tool like a Fibonacci retracement. And I'm going to do that now. So I'm going to go from the low, where the B is, up to the high, where the red arrow is, and not surprising, the standard Fibonacci, the most important one, 61.8, it's a little bit off the mark here. The RTS high here is higher than the 61.8 level, which the 61.8 level seems to be pretty accurate here. But maybe if you're not comfortable with fibs and you don't exactly know all the levels, which, by the way, if you're at Blaxe Academy, we have all the levels for you in a student package. You can use the Fibonacci's to validate your RTS or your STR and vice versa. This tends to set up not just specific price levels, but in a sense, a certain range, if you will. And that gives you a range of possibility to initiate a trade. Now, you can play this in terms of a practical setup many different ways, but again, we like to incorporate different types of tools, and as I get closer and closer in, you can see that on this 4-hour chart, there are some viable candlestick patterns in here that also coincide in this range. The particular candlestick patterns I'm looking at right now, I'm going to change the color just to accent them a little bit more. Is this small morning star here, and an even more well-formed, better positioned one that sits right on that 61.8% Fibonacci level. Again, it's below our RTS that brought us to the spot, but if you set a price alert here, like we talked about before, you'll get triggered to come look. And maybe it's not time there. As you get there, there's some red candles. And if you know your candlesticks, you know that red candles don't necessarily mean that the market is going to reverse higher. But you can wait and observe for a few more hours and see either one of these morning stars form. This gives you another point of confluence, another confirming indicator of sorts. So you have Fibonacci, you have the RTS, and now you have candlestick patterns. This turns a suggestion into a pretty high probability of success here. And again, you can see what happened. We can see what happened, but even if you couldn't, it's not that far-fetched to say, hey, I can enter here at the end of the placement of this candlestick, and putting my stop loss, you have some options here. You can put it below this Fibonacci level if you've been trained to do so, or you can put it, if you want to take a little bit more risk, you can put it below the bottom of this candlestick formation, because again, if it's a true to form morning star, which has a high probability of reversal at the right position, you know that the price shouldn't go below this level, so that's a good place to place your stop loss in terms of logic. And your target, honestly, you can do a lot of different things. You could use the measured move pattern if you knew that, or you can maybe look back towards the last high, which is over here. But either way, you have a tremendous trade setup here. This is 8.9, almost 9 to 1. That's an incredible trade. You're basically looking at gaining 9 times how much you're risking off of something that was just an observation a few moments ago. But in essence, this is exactly how the RTS works. It's a level that you could, on Nike here, as soon as this high was hit and rejected and the market moved lower, say in the early part of January, you could have set this alert, gone about your life, traded other markets, traded other stocks or securities, what have you, and you didn't have to worry about this until September. This is a period of 9 months. Now, granted, if you're trading on a smaller time frame, these will be more frequent, but the moves will likely be smaller as well. But you can see how setting alert here, just based on an observation, has a chance of paying, dare I say, dividends in the future. Because again, you may be like me, you may have another job, or you may have other engagements, or just life to live. But yet, here's a trade, an opportunity. It doesn't zero out the risk, but it hands you an incredible opportunity that otherwise you may not have been looking at Nike. Because I can promise you, with as many markets as I look at, I don't look at many single stocks often, except for maybe at earnings. But this is our first one. This is our first example of an RTS. Let's click around and find our next market. Next market is US dollar, Canadian dollar. This is a Forex cross. So if you trade in currency, foreign exchange, you may know this as being one of the major currencies of the world. Looking here, I'm basically going to take something of a guess. And this is somewhat like you would see in real time. If I was analyzing this market, I identify this as being seemingly a significant low. I see a high, and then it has retraced here, but I'm not going to inundate the chart necessarily with retracements or any of the other tools, but simply using observation of what happens next. If I look at this high in the market, and I look backwards in time, look to the left, and then look forward in time as well, you can see that there is some point of contention here. There is some point of resistance. It was minor over here, but you can see that there's sort of a double top, almost a triple top in here before it goes lower. Then as the market wiggles back up, it went higher, but not by much. So automatically, this becomes a point of interest for me. And so, again, this is where the art comes in more so than the science, because there's not necessarily an exact way to do this. What I look for is if I have a bunch of points pointing to the same resistance space or support space, what I typically do is see where the most common point is, and I draw my horizontal line. To a lesser extent, I see a support area that creates sort of a range. It dropped out of the range. And I know some of you that know technical chart patterns or the classic TA patterns may be screaming here that this is an inverted head and shoulders. Yes, you're right. But for the purposes of this, I'm just going to highlight that right through here. Well, I guess I'll show with another arrow. This point and this point sort of point to the same spots. And if I look horizontally across to the right, I see about there's still a little bit of poke through, but for the most part, you can see that there's support here as well. This is the simplicity of it all. You're literally just drawing horizontal lines. And if you're in TradingView and you know how to use it, you can add an alert on said horizontal line. and it will tell you, hey, you can do it only once, so many bars. Again, there's lots of conditions. You can do crossing, crossing up, crossing down, lots of conditions, lots of things to adjust. And here I would write that this is possible, if I can spell, RTS level. And oftentimes it's good, at least for me, to denote the level. And here is 132.40, which means that it, in currency speak, it means that it takes $1.32 Canadian to equal $1 US. But more on that in our Forex courses. But it's good whether you're trading Forex or whether you're trading stock or bond or whatever it is to denote the level, so that if it is an extended period of time between when you actually set the level, like here, and the level actually happening, you won't be too disoriented. You won't be like, well, sometimes I used to be like, well, why am I getting this message? This number, this message doesn't relate to me, and I may ignore it. And by doing so, I ignore a perfect opportunity in the markets. But as we roll forward, we're going to see, and lo and behold, this one didn't exactly work out like I wanted it to. However, it shows that they don't always work. But at the same time, had I been a little bit more judicious, maybe, or maybe a little bit more generous, just depends, and lifted my area up just by 4 pips or 4 points for you stock traders, but pips in Forex, I could have gotten a trigger here, and we didn't get a big trend change. We actually just got a small retracement. But at this point, we did get a very weak RTS. It was short-lived, and it wasn't as big of a trade as the one on Nike by any stretch of the imagination. But if you trade Forex, you know that this is roughly 87.3 pips, 87.3 points, however you want to see. Oh, there it is here. It's convenient. You know that 87 pips is a sizable trade in Forex because of the leverage. But I'll remind you again, instead of just blindly entering this trade, or maybe even if I missed it, I don't get my alert. If I'm looking that way, one of the things I can do is draw my Fibonacci to see if we have any confluence, if we have any overlay. And as I draw my Fibonacci levels, it's quite comical that once again that the 61.8% level touches exactly, and that's given, I must make sure I give the data points here. I'm starting from here, and I'm going to this high. But in doing so, going from this low to that high, once again, 61.8 provides a bounce. So there's a chance, even if my alert didn't go off, that I might have seen it. But this wasn't the monstrous trade, but it was still, before it turned and burned, depending on how you do this, it's still going to be a pretty good trade. Even if I use pretty generous stop loss on here, which I did not do in the other one. On this one, this is a trade that risks, $1 for every $1 you're risking, you're looking at getting back $3.29. Still, anything above 3 to 1 in terms of, reward to risk or risk to reward ratio, how you want to say that. Anything above 3 in my book is good. A lot of people like to shoot for these big multiples. That's not necessary. If you can make solid trades, perhaps like this one, even though it's not the biggest trade you've ever seen or the most massive gain, it's still a higher percentage win shot than if you didn't use these tools. Now let's see if there's anything else in this market before moving on. Just going to kind of draw my eye towards a few things, and it's funny enough, as I look at it again, there are some spots, and I've actually already drawn the spots if you're paying attention. This makes it a little easier. It makes it a little bit easier to explain. I started with this level here and denoted the resistance points, but as I scroll back further, there was actually a small support here. Well, you know what happens next. As the market comes down, kind of bounces back up, and then it kind of chops down through this level, we can see, not too far from where we were, that we have not one but two, and they were really in the same spot, which is ironic. But this just shows you how one single market, one really good observation can actually pay you in spades if you take the time to do so. But yes, the support here, and I really should probably swap the colors on these, but the support at this level is broken and becomes resistance points, both of which in their own regards are viable short setups. I know, shorting in some markets may seem like it's taboo, but I can tell you as a trader, you should be prepared to make money up and down in the market, and shorting is just another way to make money going the opposite direction. If you're going to trade for a long time, markets are not always going to be going in the up direction, so you can't always buy the dip. Sometimes you have to fade the peaks, fade the retracements. And by fade, I mean short, to sell them as they go lower in price. But here, the same concept remains. If I'm taking this spot as a support, I can look at the moves down into these bounces. And I'll be more illustrative here. Both of these, the first one, is a little bit more short term. It may have not produced the type of things that you want, but one thing as a trader that you don't know is the future. So if you're presenting with a trade and it looks good according to your trading requirements, and you know that it has the probability of increasing your gains, as long as it hits your risk profile, as long as you're not betting too much, you should take the trade because you don't know the future. It could bounce like this one, or on the first attempt, it could move lower like a slalom. You have to get used to taking these trades. But here, again, support broken becomes resistance, just like the textbooks on technical analysis say. And as we observe closer, once again, I see very, very familiar faces. This is an evening star, which is the opposite of the morning star there. It's a pretty good signal. From this one, again, I would have been maybe a little bit nervous in this trade, or with my current situation, I probably would not have even paid attention. But once again, you put your stop above the top of this candle, which is also coincident with the support that has now resistance. If it's resistance, the price shouldn't go above it, right? So it's a good place for your stop. And a good target for your trade would, of course, be down to the other spot that is now serving as a support. Here, it's not a multiple 10 to 1, but a 2.45 is not the worst. Maybe you don't get all of that, but you definitely shouldn't have a losing trade here. And this is a trade that, once again, as it presents itself one more time, you should take advantage of this. Now, we have already seen that this is going to produce a much larger trade. Let me remind you, though, that one tool, and some of you may have already guessed, is missing here. We didn't draw the Fibonacci lines, but that's why I drew the arrow down to show you that, to show confluence, to show where we might enter the trade. We just draw Fibonacci levels down to cover the range and see what holds. I'm going to put a level in here that some may not know, and that's the 41.4. It's the square root of 2 minus 1. it's a level that's almost as important in some markets as 38.2, which is a standard fib. As you can see, the 41.4 level is really confluent with the first level and that first trade. So, if you were a trader that traded specifically on the price points, as there are some, I used to do that exclusively. Sometimes I would even ignore the candlesticks and just focus solely on that price point in space. You can see that the 41.4 provided a confluent point here. But if you go down to the standard 38.2, you can catch not only that first one, but you can also catch this second move, which didn't quite make it back up to that resistance point. That happens in markets as well. So if you use the 38.2 here, and again, this is a level that you can set an alert just like you set the alert on the initial support turn resistance, which I have not labeled. You get a really, really nice trade setup here that's actually superior to the first one because you get to use the same point, but you get to take a more concentrated risk. And once again, your first target should be here. I don't talk about that much in these videos, but your first target doesn't necessarily have to be where you get out, but just like we've set notifications, it should be your first clue that I can get out, your first option, I can get out here if I want to. And this is an almost 7-to-1 trade to this point. If you're big into technical analysis and you know how Fibonacci levels, maybe you're a bit of a wave mechanic, you can see that there's going to be some other levels to the downside. Just taking Fibonacci levels, taking points. If I go from here to here, and this is a little bit more advanced, and put some other options on here, you can see that the price may show other spots where we can get out for an increased profit. So again, to 161.8, that's the closest thing I have on here, but the price keeps going. That has increased from a 7-to-1 to almost 12-to-1 in terms of risk and reward, which is incredible. This is the type of trade that people love. But we can see that the market really keeps going. It's going to be a function of whatever this down move is. And, you can use your measure move wave rules on it. You can use some other rules on it. But it just goes to show you that you can use these support turn resistance to the short side just like you could do the resistance turn support to the long side of the market. Here, I wanted to show, even in a volatile market, and this is another currency. I promise we'll get away from the currencies, but I know why I have this example here. This is a point of congestion in the market that honestly would have kept me out of trading this one for quite some time. I might have tried through here, but of note, sometimes you can take observations from a very long time in the past, like here. And there might have been some adjustment here because I might have moved this up a bit and just notice how many levels went through it. You can just start to count them, but I might have adjusted a little bit lower as I started seeing the market penetrate consistently below it, but really say this is support. No matter how you look at it, this is a great deal of support that goes from the beginning of July, and it's finally broken in the middle of July. So this is 2 weeks. If you add that to when you first see it, this is at the end of May. So you go from 2 weeks to 2 months of seeing the same price range. Of course, when it breaks through it in volatile markets, that does not mean that the market is going to go first in a straight line. The dynamics of markets, buyers and sellers, oftentimes there's a lot of contention. There's a lot of people who on both sides who don't believe that the price should go lower, so they're fighting. They're thinking that it's a bargain to go back up. When instead, what typically happens here is you have an STR again, and you can say this is a pretty strong one because it lasts for a long time. That comes up. Once again, when the market touches it, you set your alert. You check your Fibonacci's. You can go from this spot down to the low, taking your measurements, and see what coincides. Once again, the 38.2 is a little too low, but this 44.7, and I guess I can put a 50% on here. So the 50% hit it exactly. So the 44.7 is your point of interest because it's really coincident with that STR level. But the 50% showing, Fibonacci accuracy here, especially in markets like currencies and futures, it tags it to the T, and you get a beautiful reversal here on the 2-hour chart with a bearish engulfing pattern that kind of just seals the deal. And once again, this is a short pattern that, if you're playing by the rules, you come here and you put your stop just above that high, and then it goes wherever you want to go, and you can place your target. There's a conservative target would have been some Fibonacci level related to this upswing, which oftentimes you can take a Fibonacci retracement of 127.2% or 161.8%. You can go on to the rest of the Fibonacci's 200, but I can tell you that this is a monstrous move. Even if you're going down to the 161.8, you have a 5.6 to 1, but this trade goes on for months. It is a killer. It is a monumental trade, and that's why I brought it up, that it's important that some of these STRs and RTSs are going to give you little winners. Some of them are going to give you incredible winners with a very tight risk profile. This is why I bring this up as a practical use of the logic that comes along with support and resistance. Sure, support is what holds the price up and resistance is what pushes it down in certain situations. But if you can use the market dynamics to change between support turning resistance and resistance turning support to your advantage, you have a way to consistently find winning opportunities in the market. Not all of them are going to win, but over time, you will often find a high probability of winners compared to your losers, especially if you can execute, and especially if you have other tools like candlesticks and Fibonacci to aid you in finding the right spots to enter the market. We'll look at a few more, and after that, I think it's a good time for you to take what you have here and practice. I'm going to skip. Well, no, I'm not going to skip this one. This is real quick. There's two of them here, and hopefully some of you identify them very quickly, but I'm just going to do them. If you look right across here, there's a high. The market itself retraces, makes some sort of really a triangle pattern, which is another sort of classic TA thing, and then in very measure move form it shoots up, but as you can see, as it breaks through this high, look what happens to the next move. It starts to retrace, and eventually the first retracement doesn't get it, and sometimes it happens. This is just market dynamics, but the second retracement comes right into the range, and you know the drill here. We draw our Fibonacci levels. This one's going to be a little bit lower than 61.8, but not by much. So again, if you don't know your levels or you're not comfortable yet, 61.8 is always a good guess if you have to guess. So 66.7, it may have touched the 70.07 level. It really doesn't matter. This is good enough to initiate a trade. And this one, even though it's in currencies, this is a very volatile currency. So this one's going to give you a pretty nice appreciation relative to where you would put your stop, which is again below the candlestick patterns here, and I will zoom in just shortly to show, or you can put them, oh, this one's pretty coincident, so you get the best of both worlds. You can put your candlestick, it's below the candlestick here, which again, this is sort of a really weird, it's sort of a morning star, but not really. It's a partial bullish engulfing here, so there's that. But you have really good risk to reward ratios, and even if you took it to the top of just the last highs in the market, if you were just unsure about some of your other analysis as to where you might want to get out, you could place it there, and you have a trade that is 5.4 to 1. That's great. If you are a little bit more astute in your measurements, you can set a trade up here that would be at the 61.8% level, which is basically a retracement of this move. And that gives you an even better trade of 9.25 to 1. Just off of, again, this is a version of resistance, turn, support, which if you're going to go long in the market using these concepts, it's the RTS. If you're going to go short, it's the STR. Just flip them around, and they flip around and function as well. The last spot here I saw was something that was about the same thing. It's these points in here. I thought I would be able to get away with using the same line, but not quite. Again, market dynamics change a little bit, so it keeps us on our toes such that we can always practice. But if I do the exact same thing, and I do mean the exact same thing, looking at this point, and also here, and mind you, this is in December, middle of December. It took until the first week of January. The market had only been open 2 days, and lo and behold, we have yet another situation where market breaks through the level, then comes back to it, and I'm going to have to put 61.8% on here, and you will see that it is confluent with the RTS, just like before, and we have another really, really good trade set up. For the interest of time, I'm not going to put that one on here. But I think we've shown enough examples here to give you a good idea of how RTSs, STRs work in the markets. And so now it's incumbent upon you to do like I'm going to do now and start marking off levels that may work in the future. There's nothing saying, and maybe we'll have a follow-up video, there's nothing saying that the market, from where it is right now, won't move lower. In fact, it's probably going to move lower. The question is, does it move lower here, or does it extend itself? If it extends itself, all we have to do in advance is anticipate it. Possible RTS, and I put my price levels in, make sure that they're about the right levels, and we wait. And you can go off trading, practicing, but I do recommend taking this into strong consideration as being one of the key tools. It works no matter the market. I can keep going in different types of markets, different types of situations, and the results are going to be about the same thing. Once you learn this, practice it over and over. Simulate your trades first, please. Make sure you get the mechanics down of finding the levels, setting the appropriate alerts, making sure that they have confluence, and then moving on. This is key. Once you get the mechanics down, it becomes very rudimentary. It becomes second nature, and that's how you want these, because then it doesn't seem like it's work at all. So, in closing, make sure you use your technical tools to help find and validate these resistance turn supports and supports turn resistance. On your charts, make sure you chart them cleanly. Don't muddle your charts with tons of lines. Take your time, look backwards in time to see if there's some precedence of a certain area providing support and resistance, and then walk it forward. Set your price alerts. This is the actionable part of it. The first two parts, that's the analysis. Once you get the analysis down, once you start to find them in the past, look at tons of charts. There's nothing saying that, oh, you're looking at one or two charts. No, look at 10, 20, as many charts as you can find in different markets. Don't always, if you're a stock trader, don't just look at stocks. If you're a Forex trader, please don't just look at Forex. Check out all different types of markets, all different situations to see how you pick up on what could be RTSs and STRs. And then take the action part, because this really actualizes the knowledge. Knowledge itself doesn't do much for it if you can't do anything with it. So take the next steps to set the price alerts, and then have a plan after that. Once the price alert hits, use your trading plan, use your rest of your tools to enter the market after you quantified your risk, and then it should set you up with a tool that you can use to consistently find opportunities with good risk to reward setups. I hope you enjoyed this video. I really hope you go out and practice, because that's what these videos are about in particular. And I look to see you with more at Blaxe Academy. Thank you.